risk management and day trading. I promise you, this is going to be the most important video ever on my channel, especially if you're serious about becoming a profitable trader. The most difficult part in trading is not necessarily making money, but keeping your profit. True story though, I was in a really bad trade trying to long PDD because it flushed down really quickly to daily support. And guess what? I got dumped. Faster than my ex-husband dumped me. So this is the stock in question, PDD. You can see at the open it flushed down from 49 here all the way down to $46, $45, and near the lows at $39 at 10:30. So I was in about 1,000 shares. So this trade I could have lost $10,000. But luckily I had this one crucial component to my trading strategy, which is risk management. So when the stock dropped to 45.60s, 45.70s, I stopped out for a loss. So on 1,000 shares, I lost about $1,000, which is about 1% of my account size. And then in the next trade, I repeated the same strategy, risking 1% of my capital and made a decent $2,000 on BABA, $2,000 on PDD short, $3,000 on NVIDIA, which are around 2 to 3 times of what I plan to risk on all of these trades. If you want to learn how I managed to do that, pay attention to this video as I'm about to explain my risk management strategy in 3 steps. Also, please remember to smash the like button right now if you want to receive a free crash course on my risk management trading strategy. I'll tell you more about that later on. Risk management is the foundation in day trading. If you don't manage your risk, you'll never become profitable, especially if you have a small account. Let's be real here, no one can predict whether a stock is gonna go up or down with 100% certainty at any given time. But if you can though, call me first. Therefore, as traders, we can never truly control how much profit we make, as we can only profit from what the market gives us. But we can definitely control how much money we lose. This leads us to the first step of risk management for traders, understanding the power of risk-reward ratio. So I'm gonna show you the example of setting a proper risk-reward ratio according to your account size on this spreadsheet over here. So let's say I have a $10,000 account capital. You should be risking about 1% maximum per trade. So if I have $10,000, the 1% would be $100. For each trade, I'm risking $100. However, if you're a little bit more conservative and you'd rather risk just $100 per day, you can do this as well. So $100 is your max risk for the day. But if you take 3 trades per day, 2 trades per day, that's gonna vary your amount of risk per trade. So if I take 2 trades per day, so for each trade, I'm allowed to risk $50. So whichever method you use, that's fine, but make sure you stick with it. Your max risk per trade or your max risk per day divided by the number of trades you take on a day. So have that figure in mind because this risk amount is gonna be kept constant to the best of your ability as a trader for every single trade that you take. So now that we understand the fixed risk per trade concept, let's look at risk reward over here. So I'm using the same $10,000 account capital. I'm still risking 1% of my account size per trade. Now let's look at risk reward now. If I have a risk reward ratio of 1:1, meaning that when I make money, I make $100, and when I lose 100. Let's see what happens if I have a 50% win rate, meaning for every 10 trades, I make money on 5 out of 10. So if I'm making money on these 5 trades, 50% win rate, and then lose money on the other 5, I'm pretty much break even. Now, this is without considering commissions or your platform costs. So essentially, you're red if your risk reward is 1:1 and you have a 50% win rate. Now, 50% win rate is really optimistic for new traders. I would say for most new traders, your win rate is probably 40% or less. So that's the reason most new traders and most, traders struggling, they are unprofitable because they are risking the same amount as they are making. So that means, first of all, they have trouble managing their stops, or they have trouble with the right strategy to let their trade work out to maximize the winners. But we're going to come back to that in a little bit. Moving on to the second scenario, you can see we're still risking the same amount of $100 per trade, but now our risk reward is slightly better. We're risking $100 to make $200. So that means with 50% win rate, yes, we can indeed become profitable at $500. Now, if we drop down to a win rate of only 40%, we are still profitable. So that means you are no longer relying on being right. You're relying on managing the proper risk. You lose $100 per trade, but when you make money, when you are right, you are at least 2 times. Your reward is 2 times greater than your risk. So this is at least the minimum you should go for if you are a new trader. Remember, with only a 40% win rate, you can still become profitable. But ideally, we want to work towards 50% win rate and with a 1-to-2 risk-reward ratio. Now, if you're trading a small account, for your account to really see some substantial growth, you need to work on your risk-reward ratio of 1-to-3 or more. So in this bottom scenario here, you can see we're still risking $100, but this person knows how to manage the risk, so they only lose $100, but when they make money, the profits are 3 times more. So when you make money, you make $300 for 5 trades out of 10. So 50% win rate, you can become very profitable. You can see you're green $1,000 on those 10 trades, even with only 50% win rate. Now, let's say I drop my win rate down to only 40%. You can see I'm still profitable. I'm still positive 600. Let's say, how about 30%? What would that look like? Look, even with only 30% win rate, as long as I'm really good at maximizing my profit and reducing my risk to only $100, I can still be profitable. Now, but where the magic really comes in is when you have a nicer win rate of around 60% on average for most traders, 60 to 70% win rate, then you can become very profitable if you have a 1-to-2 risk reward minimum, but ideally 1-to-3. So if you're trading a smaller account of $1,000, that means your risk should only be $10. If you're trading $5,000, your risk should only be $50. So you should not take on more risk than you should. This is the guideline that you should be looking at for all the trades you're taking. In the next step, I'm going to show you the step-by-step process of how to properly set your stop loss area and take profit on your chart. So you always get 1-to-2 or 1-to-3 risk reward. Before we do so, I want to remind you that you can now receive a free training on one of my favorite long strategies, as well as risk management crash course in the link below. I'll be going over one of my favorite strategies in the market right now for buying stocks and how to find stocks to trade, especially my risk management strategies for that particular setup. So make sure to check out the link below. So if you look at a daily chart, on this gap down, this thing really didn't have any support from 60, 52 down to 47. It didn't have support until about over here. $46 here. So that's the reason I longed over here, $46 with the daily support area when I first longed the stock. However, I know that if I'm wrong, I need to be able to get out because this thing has downside all the way down to $40.39. So downside is potentially another $10 to a downside. So I obviously don't want to have to lose another, this is what?
46 minus
$7. So I know that, I want to keep my risk as close to 46 as I can. So that's the reason I kept it at VWAP rejection over here. When I first loaned the stock at 46, it tanked down to 45, 30 really quick, and you just cannot reclaim back. I'm on the 5-minute chart. I use the 5-minute and VWAP over here. I always look at if the stock is able to reclaim over the key level, $46, over VWAP, and to gauge whether there's a potential reversal. And the fact that there isn't, after this thing dumped to 45, small pop to 46, the fact that it just couldn't bounce, it cracked through the low of the day, that's why I stopped out around 45, 30s over here. So I lost almost pretty much $1,000 on that trade on the 1,000 shares. So this thing cracks through the lower day. So pretty much I'm risking over here around 80 cents, 90 cents with slippage. So that's the amount of risk I took on that particular trade for the long side. But it's really good stop, because if I didn't stop out, this thing next leg went all the way down to $41 and $39. So what I did well is keeping my risk at that 1% mark, stopping out when the stock breaks down the low over the day over here at 45.20s. So I got out of the long trade, which I lost $1,000 on. Now let's talk about the shorts I took. So after this thing dropped from 45 down to 42, you can see the small consolidation here on the 5-minute chart over here. Let me maximize a little bit. A small 5-minute consolidation, a lot of wicks on the top. Over here, you can see 5-minute wicks on the top. And if you watch our price action video, you know that wicks on the top of the candlesticks means each push, each breakout, each bounce is sold into. So this is a bearish candle formation over here. So that's the reason I shorted it over here. At 42.50s over here, 42.50s, I shorted it. Now when I short the stock, my risk is about VWAP area. So around 42.40, that's my entry. My risk is about $1 over here. $1 risk over here on the reclaim of this VWAP area. So I will probably risk only up to $43 up here around this area. I probably wouldn't want to risk a full $1 per trade, but an 80-cent risk on this name. Downside, I know from 42.40's entry, this thing has a potential of giving me all the way down to $39. Why? Because that's a daily support area that we drew earlier from the daily chart. So that's a pretty decent risk reward, at least 1 to 2. So I'm risking about 80 cents to make, somebody do the math.
Here we go again.
42.
A few moments later.
So if you think about it, I'm risking about 80 cents to potentially make $3.40 to a downside. That is more than 1 to 2 risk reward and 1 to 3 risk reward. So that's why this short on the short side for PDD was really worth it. Even though I just lost $1,000 on the long side up here, I shorted it down here from 42.50s all the way down to $39. So to me, the second trade is a trade that's well worth it. So here are the key takeaways for setting the proper stop, the risk area, your profit target, and the proper risk reward. So number 1 is to use the daily key levels from the daily support and resistance areas as your risk. And number 2, use the upside resistance or downside support as your daily profit areas. This is gonna help you gauge your risk reward to make sure when you risk $1, you're potentially going to make $2 or $3 or even more. And number 3, make sure all of those key levels and daily support resistance areas are drawn out on your charts, like our demonstration here, before you enter the trade. Now, step number 3 is knowing your strengths and weaknesses as a trader and set proper rules for yourself. So I can teach you all about this risk management, max loss, calculating your risk for your account capital, but none of that matters if you are not disciplined enough to follow it. So that's why I always suggest that all the traders, after having calculated your risk reward like I did in this video, do that in paper trading first. Do that and apply it for all of the strategies you're trading and track them in a proper trading journal. It is from there that you can see your risk reward for all of your trades. Are you risking $10 to make $10 or $10 to make $5? I hope not. But that's how you see your actual risk reward after all the executions and all the slippage. So you should really be tracking that. So that's number 1. Number 2 is write down a list of rules based on what you find in your trading journal. Do you find that you start losing money after about 11 a.m. or 12 p.m. market time? If so, then that means you should step back and stop trading after that. That's personally what I do, because that's what I find for my trading journal. I start losing everything I made on the day after about 11:30 a.m. in the morning. So that's why I'm now really disciplined enough to stop trading. I also have another rule called the 30% rule, meaning that if I find that I'm giving back around 30% of my profit on the day, then I stop trading. This is to prevent myself from over trading and outstaying my welcome and revenge trading, try to make every single penny back. Because it's inevitable. Sometimes I'm good on the day, I make some decent trades, I'm up a couple $1,000s, then I become really bored and undisciplined and give back more than 30% or 50%. So now I'm really conscious about my own emotions and own trading performance. If I give back more than 30% on the day, then I'm done. Because hopefully you've realized this by now, watching this risk management video. The most difficult part in trading is not necessarily making money, but keeping your profit. That's the hardest part in trading, and that's where most traders struggle the most. They make $100 here, $200 there, and they lose everything and more. So that's the reason you should really have a list of rules that you follow, and to stay disciplined, track all of your trades in a trading journal, and truly understand how much money you should be risking for your account size. Once again, if you want to learn more about my risk management strategy, including one of my favorite long setups right now in the market, then you can get a free crash course in the link down below. If this risk management video helped you out, make sure to let me know in the comment section below. Thank you guys so much for watching as always. I'm the Humble Trader, and I'll see you guys next time.